Hello traders. Today I want to break down one of those ideas that changes how you look at the chart forever. These are order blocks, the very zones where big money enters the market. An order block is a key area on the chart where significant trading volume is concentrated. Large players such as banks or funds use these zones to enter the market. There are two types of order blocks. The first is bullish. It appears when large capital is actively buying. The second is bearish, when money is exiting or selling. Let's break down why these zones are important. Because in a large transaction, the entire volume is rarely executed at once. Some of the orders remain unfilled, and when the price returns to this zone, it once again encounters the interest of major players and often bounces. That's why experienced traders use order blocks to look for entry points with minimal risk. And here it's important to understand, an order block is not a support or resistance level. A level is formed by many touches. An order block is the opposite. It appears once, the price reacts, and the zone is no longer considered fresh. So how do we distinguish a real order block from a random impulse? There are three strict criteria for this. The first sign is imbalance. When a large volume enters the market, the movement is not smooth, but explosive. A small gap forms between candles. This is the imbalance. To find the block, you mark the first candle before this inefficiency, from the lower wick to the upper wick. This is where the major move began. The second sign is that the block must be untouched. If the price has touched this area even once, even with a thin wick, the block is no longer valid. The internal orders have been absorbed, and there is no second signal. The third sign is a break of structure or a change of character. If a block is the footprint of large participants, it is always followed by a change in market structure. In an uptrend, each high is higher than the previous one. In a downtrend, each high is lower. A break of the previous high is a break of structure. A transition from growth to decline is already a change of character. And only if after the block we see a break or a change of character can we say that this is a real, valid order block. When you filter out everything else, only a few zones remain on the chart. But these are exactly the ones that provide real entry points. Now I'll talk about several strategies that can take your trading to the next level. The first strategy is multi-timeframe confirmation. The idea is simple. First, you find a block on a higher time frame, a 4-hour, daily, or even weekly chart. You choose only those that have imbalance and a break of structure. Then, you wait for the price to return to the block. When the price approaches the zone on the higher time frame, you switch to a lower one. For example, a 15-minute or 1-hour chart. And here you look for a reaction, a reversal pattern, candle engulfing, a break of local structure, divergence, or a small impulse showing that the market is reactivating. If everything aligns, the entry is justified. The stop is placed slightly above or below the block, and the take profit is usually twice the size of the stop. This gives an excellent risk-to-reward ratio. The next strategy is the inducement trap. This is one of those ideas, after which you'll start seeing the chart very differently. Imagine a situation where the price repeatedly bounces from a small support level, 2, 3, 4 times in a row. Everyone sees this level. Everyone thinks it's reliable. The crowd places buy orders and stop losses just below it. But right under this level lies a real order block, and that's exactly where large players are waiting for their entry. What happens next? The price breaks the obvious level, triggers the stops of most traders, and only then reverses from the order block. So how do you trade this strategy? You place a pending order right in the middle of the order block. If the price doesn't reach it, you skip the trade. If it does, the entry is ideal. At the lowest price, when the crowd has already exited with losses and the market is just starting its move. This technique provides astonishing accuracy, especially when combined with a higher time frame. Finally, let's break down the third strategy. It's based on a broken level that changes its role. An order block is generally a one-time zone, but there is an exception. If the market fully breaks through an order block, the trend changes, and that same area turns into a new resistance or support level. Such a block is called a breaker block. When the price returns to the block from below, it's an excellent buying opportunity. The stop is placed just below the zone. The take profit is 3 times the stop, or at the nearest significant area. Breaker blocks are very powerful because they reflect not just a price reaction, but a decision by large players to switch sides. Over time, your eye starts spotting these zones automatically, and the chart becomes predictable, like a book written by big capital. If you liked it, hit the like button and write which topic you'd like to see next. See you in the next video.